Welcome to Kitchen Table Finance, the podcast where we serve up bite-sized pieces of financial advice to simplify your money and your life.
Hey, Dave, how you doing today?
I'm doing great, Nick. How are you?
I am doing well. We are back for another new exciting season.
Happy New Year.
Happy New Year, season 4 of the Kitchen Table Finance podcast. And honestly, what I was most looking forward to in season 4 was a new weather report from you since you're in a new location.
Well, yeah, I'm 927 miles almost directly south of where I usually am, and it is snowing. It is 30 degrees, and we're under a winter storm watch, and you would think the state of South Carolina has never seen anything other than 50 degrees and sunny. There was a run on the grocery store last night. People were salting their sidewalks, I think with table salt, because that was what they had. And schools were canceled. The hockey, we were supposed to go to a minor league hockey game tonight, and that is rescheduled. I'm sure those Canadian boys are laughing about having the night off.
We are back with season 4, Dave, and this is always one of our favorite episodes of the year, and that is our prediction episode. So we are here today to review our predictions from 2024, and if we're brave enough, make some more for 2025, right?
Yeah, right. Always humbling. This is always an exercise in futility, and we start from that premise. And before we get to our results, I'd like to point out that I don't really think collectively we were any worse than any of the people that get paid a lot of money to make predictions.
It's just another fine example every year of how hard it is to make predictions. Looking at a chart that we got from Dimensional last year, the S&P 500 index ended the year at up 23.3%, well over the historical average of 12.3%. And the highest prediction from the major banks fund managers was Oppenheimer, looked at, what is that, about 7, 8, 9, 10%?
Yeah, they don't label it, but yeah, it's about 2/3 or so of what the actual results were. And that was the closest.
Yeah. The worst on our list here is JP Morgan actually predicted an over 10% loss last year. So they're way off the mark.
Right. The majority last year pretty much predicting somewhere a little bit less optimistic than Oppenheimer was, but positive.
Yeah. Mm-hmm.
I think the interesting thing here is when you consider what the incentives are for most of these investment firms, they don't want to be pessimistic.
Right.
They also don't want to look silly by predicting like really great returns that don't materialize. So, and I think when we look at what the predictions are for next year, that kind of bears out.
Yeah, that's a great point. Obviously, if you're an investment manager, you don't want to, tell people the market's going to go down 20%, but hey, make sure you invest with me still, right?
These folks all work for major investment houses. Telling people that the markets are going to stink means people are going to take their money away from your investment house. So there's no incentive there to be anything other than positive, really.
Yeah.
While Oppenheimer was the closest of the major firms last year making a prediction on what the S&P 500 would do, what was your prediction, Nick?
I'm so glad you asked, Dave. I'm actually thinking about going to one of these major firms and seeing if they'll pay me for my predictions after last year.
I from now on, I'm just telling clients to ask Nick, what was your prediction last year?
So I pulled up, I guesstimated that the S&P 500 was going to be up 22% next year.
Yeah.
So I was off slightly of the 23.3% mark. But before we start calling me Nostradamus here, it was under the preface that the Lions would win the Super Bowl. Well, because an NFC team won the Super Bowl, the stock market would go up.
Yeah.
Apparently, I'm a much better stock market prognosticator than a football one.
I don't know. If you think about the odds in pro football too, you were what? One good drive away from being right on that one too.
We were close. Best year of my life being a Lions fan. So
the next step we need to talk about is how you arrived at that 22% prediction. And it was basically you had me make my prediction first, and then said I'm going to say the opposite, because my thoughts were that it was going to be a pretty blah year, not necessarily negative, but that we weren't going to see a lot of upside to the markets last year.
Just goes to show you like
Mhm.
the futility in trying to like pinpoint some of this stuff.
Right.
Every once in a while you get very, very lucky, but most of the time you will not.
Right, right. Well, and I think the important thing to realize here, people expect us to have an opinion on where things are going. We're always thinking about what
Mm-hmm.
might happen, but we're also always telling those people, "Hey, I'm not investing. I've been doing this for a long time, and I'm not changing your portfolio based on my gut feelings. Most years, my gut feelings are similar to what they were at the beginning of last year,
Yeah.
and most of the time they're wrong. Sometimes to the good, sometimes to the bad, but not anything I would ever encourage anyone to invest around. We make those decisions based on long-term interplays of stocks and bonds and long-term averages and what we expect, based on economic cycles, not based on the moods of the market from,
Mm-hmm.
1 month, 3 months, 6 months, 12 months.
In all seriousness, I know this is obviously tongue in cheek kind of predictions because it's fun and people kind of expect it. But how we actually truly operate is that we assume that year over year, the market's usually going to go up because
Right.
historically that's what happens. But we
Well,
are always
yeah,
prepared for the opposite, right?
yeah. To be an investor at all, you've got to be an optimist.
Yeah.
Maybe not like on a 6-month, 12-month basis, whatever. It's going to be pretty random. But if you don't believe that the economy grows and that the markets grow over time, you really shouldn't be investing in stocks at all. It's just a matter of what's the chatter going to be in the meantime.
Just because we have to, because we agreed to do it every year, Dave. Let's go through some of the other predictions that we made last year. It looks like you took the point of international outperforming U.S. stocks this year.
Didn't happen, not even close. It was positive, but
And you kind of took the flag for me because that was usually my saying over the last couple of
yeah,
years. And because you went that route, I went the opposite. And so I,
yeah.
win again,
You
basically
once
by
again,
countering you. The other thing that was kind of actually more interesting to me, if I would have had to say that this one was the most likely of our predictions to come true, and that is that we were going to have big swings last year and lots of
yeah,
volatility.
and
And we really didn't.
no, other than mid-July, end of July, we
Mm-hmm.
had the issue with the Japanese yen caused a real close to a correction,
Yeah.
but didn't last more than a couple weeks, and we were right back floating along to the positive again.
Yeah, from the market's perspective, I
Yeah,
know we talked a lot about the election and how that could increase volatility, but we really didn't
yeah.
see a ton of it during election season. I mean, everybody had heart palpitations, but
hmm
the market
Well,
seemed to be pretty steady.
the old cliche that a bull market climbs a wall of worry. I think 2024 was the standard bearer for that cliche, because everybody was worried about everything that was going on and what might happen with the election, what might happen with the Ukraine and Russia and everything else that was going on, and yet the market just kept going and going and going. The flip side of that is when everybody thinks everything's great, then there's no upside left in the market. That was, I think, one of the major lessons from last year, because there was plenty to worry about and plenty of
Yeah.
when we talked to clients, everybody was like, "Okay, when does this all fall apart?" It'll be interesting, to see, because I think everybody still has plenty on their minds. The contrarian in me is, as long as people are worried, that last dollar hasn't been invested, right?
Mm-hmm.
As
Mm-hmm.
long as people are holding back and thinking, "Oh boy, it may go down from here," then that's actually a positive thing for the markets.
Another prediction that I made actually that did not age well was increased transactions in the real estate market. I really thought things would start to pick up as interest rates came down, and interest rates did come down, but it didn't really lead to much lower mortgage
Mortgage
interest
rates,
rates. And
right?
so we've still seen a lot of like people hanging out and not
Yeah.
getting rid of their 3% mortgage. And so we haven't seen as many increased transactions in the real estate market than I thought for sure.
Yeah, well, you weren't alone in that mistaken assumption, myself included, but along with every Wall Street pundit I remember from last year.
Obviously we did see some rate cuts last year and inflation come down, which we talked about a little bit. And one of the things that you actually got right was Longer interest rates are going to stay higher.
Yeah, that's going to continue to be a major theme here over the next 12 months, no doubt.
Speaking of 2025, Dave, I know we've done a little bit of work on seeing what our competition is up to and where they kind of put things this year.
The broad thoughts out there amongst all the different investment banks that publish these things boil down to a few basic themes. And I don't think any of this is going to surprise anybody or is any different than what you and I were thinking about. Policy uncertainty is really high right now, right? We've got a change of administration. We've got a lot of ideas that have been floated that have a lot of potential economic impacts that are hard to quantify. Tariffs, tax changes, what's going on with alternative energy programs, all of these things will most likely impact the economy, but are very hard for anyone to quantify ahead of time what those
Yeah.
impacts will be. And that all rolls into inflation and interest rates and growth overall. The consensus seems to be that the economy will continue to grow. We're not headed to recession. We're sitting here in early January and we've got new job numbers today that looked pretty good. The consensus seems to be that companies' profit margins will rise, which will start to justify some of the high valuations that we have now. And that's that's the other side of the scale, right? We've had 2 really good years in the markets, and now we need to see earnings come up to justify those prices,
Right.
those valuations. And so that's, when valuations get stretched, either the earnings need to rise or prices need to come down, one or the other. I was glad to see this. The consensus amongst most of the big banks seems to be that earnings growth will start to broaden out more. So as we've pounded on ad nauseum over the last 2 years now, the market has really been driven by a handful of big tech companies and the expectations for how AI is going to play out. And the thought now is with the strength of the economy, we should start to see earnings growth play out across broader parts of the market.
I've been seeing floating around LinkedIn and some of the social medias this chart of how the U.S. would actually have underperformed the IFA if NVIDIA was stripped out of it, which I don't think is a fair comparison because I guess we'd have to strip out the best performing stock in the international market.
That reminds me of a particular football coach saying that if it weren't for like 2 or 3 plays, they would have won the game. I was going to say I should get partial credit for my comment last year on international markets catching up, but if it weren't for NVIDIA. The range of projections amongst most of the major contenders seems pretty tight this year. So as we opened the year, the S&P 500 was at 5,868. The range of predictions were all positive for most of the big players, with UBS on the low end predicting 6,400 on the S&P 500, so about a 600-point gain or about 10%, with a pretty good group around 6,500 for the S&P, including Morgan Stanley, Goldman Sachs, JP Morgan, RBC, Barclays, Bank of America. And then on the high end, Deutsche Bank put a target of around 7,000 on the S&P 500.
Wow, positive across the board, though.
Yeah. None of the major players were gloom and doom. I will note Morgan Stanley was the most detailed in their approach, and they gave a really wide range. I kind of chuckled when I read this. Their projection is 6,500, but their bear market projection is 4,600 and their bull case is 7,400. So expecting about a 10 to 12% gain, but hey, it could be anywhere from a 25% loss to a 25, 30% gain. That just shows how futile this exercise really is. Because Morgan Stanley's a bunch of they're hiring the best and the brightest minds as far as economic thinking goes, and that's the best they can do. Somewhere between a 25 to 30% loss and a 25 to 30% gain. And I'll bet they'll be right. If we take that range, I'll bet they'll be right. The results will be somewhere inside that.
Right. Isn't that what we always say on this episode? If you're going to make predictions, make a lot of them because one of them will be right. Yep. Dave, a little drum roll for where you think we're going to be this year.
My predictions for 2025 are going to look a lot like 2024. We've had 2 really good years, right? And I'm always telling clients, when the markets outperform expectations, at some point it reverts to the mean, right?
Yep.
So that kind of makes me think I just can't see like another 20% year on top of two previous 20% years.
Mm-hmm.
But at the same time, everything we're looking at economically looks positive right now.
Yep.
Inflation has
Yeah.
been trending down and may be more stubborn than expected, but that's because we've got growth too. And you're going to have some inflation if you have economic growth. So, and the job market still looks positive. So, from where I'm sitting, it's hard for me to say, oh boy, 2 good years. Now it's time for, that third year to correct things. So I'm kind of thinking, by way of being wishy-washy, we probably end up somewhere around where we're at. And you made me write it down, so I put 6,000. So a modest gain
Love
on
it.
the S&P 500. If we do have that happen, I would expect to see rotation amongst the winners and losers.
Mm-hmm.
So we've seen this huge growth from AI,
Mm-hmm.
and I don't know. Part of this is I got my brokerage license 2 months before the tech bubble burst. I know I've said that before, but that was the early 2000, and it had been all just bull market tech before that. And at some point, those technologies need to start paying off, and there's probably going to be a lag before they do. So
Yeah.
I have trouble seeing like Nvidia keep going the way it has, even not that their business is necessarily going to go poorly. It's just they're priced for perfection, really.
Right.
I would expect if we're going to see positive or balanced markets, at least it's going to mean that like some of the things that haven't done well for the last few years start to do better. More
Mm-hmm.
value stocks, more everyday kind of things. That's my big prediction. And along with that, I would expect it's time for small cap stocks and maybe international to finally catch up a little bit. Which, okay, so back to what you were saying, if Nvidia hadn't, if I'm expecting Nvidia is not going to do as well, see that
Yeah,
balanced return. Valuations, right? I
for
mean,
sure.
we still have modest valuations on a lot of small company stocks and a lot of international and emerging market stuff. And U.S. large companies and especially tech are higher on their valuation. People are going to start to buy the things that look cheaper at some point.
I actually agree with you this year. I'm not taking a contrarian point of
Ooh,
view.
scary.
I'm thinking
Okay.
the S&P 500 is going to be up about 5%, which puts, by my basic math, at 6,161. That's what I'm putting down on the line
I,
here.
I just wrote it in our notes. So,
Perfect. It's out there now.
yep.
And then I also agree with you on small cap value doing a little bit better, outperforming, and international. I think this year has just got to be the year. It's been too long, and the valuations, like you said, eventually things revert to the mean, right? And so that we should expect that this should be the year. And so we shall see, right? It's a dangerous
Well,
game when we're both on the same page, I suppose.
yep. And till then, we'll stay diversified and we'll stay invested and we'll have bonds in there to help leaven things out. I'm certainly not recommending any of my clients change their portfolios based on anything that we've said here today.
I think, like we talked about earlier, where, we're predicting things to go up, but we're also prepared for them not to. And
Mm-hmm.
one of the blog posts that you wrote recently was about lifeboat drills on that
Mm-hmm.
topic
Yeah.
of just, how to think about how to be prepared for those.
Yeah.
And I know that's going to be a podcast episode of ours in the future, but we'll put the link to that in the show notes if our listeners want to read that article ahead of time. But I think that's, I personally get pretty scared when markets keep going up and up.
Right.
I've lived through the realities of there's always the other shoe to drop. And so
Yeah.
nobody knows when, but being prepared for it is a good idea.
Yeah. And the one thing I'll add to that is it's not going to be the thing that we think about, right? I mean,
Right.
I listed off the things on my mind. The thing that would upset the markets is not going to be on my list, really.
Yeah. Right.
It's going to be that thing that we haven't thought about, like COVID was. You can't prepare for that. You can't time it. What you can do is get yourself mentally ready.
Right.
Just know it's likely.
For sure. Any other big bold predictions for us in 2025 there, Mr. Shotwell?
This is the Lions year if ever there was one.
Yeah, I love it. Looking good. Looking
So
real
there we
good.
go. Yep.
They seem to be a team of destiny.
Yep.
So
I'd like to predict this is the year the Red Wings get back in the playoffs, but I don't know. That might be a bridge too
well,
far.
yeah, they're looking better as of late, but they got a ways to go.
So, all right.
As always, been a pleasure, Dave. For our listeners out there, if you'd like to share your predictions with us, we would love to hear them. Shoot us an email at info@srbadvisors.com. And with that, Dave, I look forward to seeing how we did next year.
Yep. Check the score. All right. Take care.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.